Economists expected America to add 60,000 jobs last month. Instead, it lost 92,000. That same week, Moody's chief economist told the world that the AI model they used to predict recessions had hit 49% probability. One more point, and that model has been right every single time for 80 years. And here's the part that nobody is saying out loud. Those numbers, the job losses, the 49%, were calculated before the Iran war started, before oil crossed $100 a barrel, before energy prices began hitting every business in America. In the next 10 minutes, I'm going to show you exactly what is happening, what history says comes next, and the 5 moves to make with your money right now before the model crosses that line. Here is what makes this moment different from the usual recession scare. Most economic downturns start with one problem. A banking crisis in 2008, a pandemic in 2020, a single identifiable shock. Right now, there are 3 separate forces hitting the economy at the same time, and they are feeding each other. Force 1. A job market that was already struggling before the war. In all of 2025, a full calendar year, America added just 15,000 jobs a month. For context, during the post-pandemic recovery of 2021 to 2023, the economy was adding nearly 400,000 jobs a month. That boom is over. Force 2, an oil shock that every economist knows is dangerous. Brent crude oil crossed $100 a barrel for the first time since 2022. And here is the historical fact that should make every investor pay attention. Every U.S. recession since World War II, except COVID, was preceded by a spike in energy prices. Force 3, an inflation problem that is not going away. The Federal Reserve's target is 2%. Inflation is running near 3% and trending higher. That means the Fed cannot cut rates to rescue a weakening job market, because cutting rates risks pushing inflation even higher. Raymond James, chief economist, called it probably the worst scenario for monetary policy. 3 forces feeding each other at the same time. Here is what this video covers. First, what Moody's model actually is and why 49% is so significant. Second, the hidden indicator that Moody's chief economist says may already be signaling we are in a recession right now. Third, what history says happens to your investments when a recession hits. And fourth, 5 specific moves to make with your money before the model crosses 50%. Let's go. What Moody's model actually is, and why 49% matters. Moody's Analytics, one of the most respected economic research firms in the world, built an AI-driven model that tracks dozens of economic indicators simultaneously: job growth, oil prices, consumer confidence, business investment, credit spreads, dozens of variables updated in real time, running constantly. The model produces one output: the probability of a U.S. recession in the next 12 months. When the model was backtested over 80 years of historical data, every single time it crossed 50%, a recession followed within a year. Not sometimes, not most of the time, every time. It is currently at 49%. And Mark Zandi, Moody's chief economist, said publicly in March 2026, "It isn't a stretch to expect the indicator to cross the key 50% threshold amid the Iranian conflict and the resulting surge in oil prices. If oil prices remain elevated for much longer, weeks, not months, a recession will be difficult to avoid." The indicator that may already be telling us we are in a recession right now. You may have seen the March jobs number, 178,000 jobs added. Better than expected. Markets breathed a sigh of relief. Mark Zandi told the world to ignore it. Here is why. February's 92,000 job losses were partly caused by brutal winter weather and a nurses' strike at Kaiser Permanente, temporary disruptions that inflated the rebound in March. Strip out healthcare, the one sector that was bouncing back from the strike, and the rest of the economy was actually losing jobs in March. But there is a deeper indicator that Zandy has flagged, something called the Vicious Cycle Index. The Vicious Cycle Index, or VCI, is a labor force adjusted version of the SOM rule. The SOM rule has correctly identified almost every U.S. recession since 1950. It flashes red when unemployment rises half a percentage point above its 12-month low. The VCI goes one step further. It adjusts for people who have simply stopped looking for work, and as of March 2026, the VCI has been elevated above its recession threshold for 3 consecutive months. Zandy's conclusion? The U.S. economy could already be in a recession. The official data just hasn't confirmed it yet, and here is the structural reality underneath all of it. 38 out of every 100 working-age Americans are not in the labor force at all. Not working, not looking. The labor force participation rate has dropped from 62.8% in 2023 to 61.9% today. These are not people counted in the unemployment rate. They are invisible in the headline number. What actually happens to your investments when a recession arrives? I want to be honest with you here, because there's a difference between understanding the risk and reacting to it badly. Since 1980, every U.S. recession has caused the S&P 500 to fall. The range of those declines runs from about 20% to more than 55%. The average decline during a recession is 32%. The S&P 500 is currently near an all-time high of 7230. A 32% decline from that level puts it at around 4,900. Goldman Sachs strategists have specifically warned that severe oil disruption could drag the S&P 500 to 5,400, a 22% decline from the January peak. But here's the other side of that data. The S&P 500 has returned an average of 20% in the 12 months after a recession ends. The worst thing investors consistently do is sell during the fear and miss the recovery. Since 1950, every single bear market has eventually been erased by a new all-time high. Every one. The goal is not to predict the recession. The goal is to be prepared for it, so you do not make the decisions that permanently damage your financial future. 5 moves to make with your money before the model crosses 50%. Move 1. Build your cash buffer now. The standard advice is 3 to 6 months of expenses in an emergency fund. In a recession environment, especially one where the job market is already weakening, 6 months is the floor, not the ceiling. Keep this in a high-yield savings account earning 4 to 5%. Your cash should be working while it waits. Move 2. Do not sell your index funds. This is the most important move dressed as the simplest one. The investors who permanently destroyed wealth in 2008 and 2020 were not the ones who held through the crash. They were the ones who sold at the bottom and bought back at the top. Automatic contributions into a low-cost index fund kept running through a recession is called dollar cost averaging, and every dip becomes a discount. Move 3. Lock in fixed rates now, before they move. If a recession hits and the Fed is forced to cut despite inflation, savings rates and CD rates drop fast. 4 to 5% high-yield savings rates and 12-month CD rates above 4% are available right now. Lock in a 12 or 18-month CD with money you do not need immediately. That rate is guaranteed, regardless of what the Fed does next. Move 4. Review your debt exposure. Recessions kill jobs. If your monthly minimum payments, mortgage, car, credit card, require both incomes in your household to cover, that is a vulnerability. The goal is not to panic, it is to know your number. How many months could you cover your minimum obligations if one income disappeared? If the answer is under 3 months, that is the problem to solve first. Move 5. This is the one most people miss. This is the one most people will not think about. A recession is also a buying opportunity. If the S&P 500 drops 30%, every dollar you invest buys 43% more than it does today. Every investor who entered the market in March 2020, at the height of pandemic fear, doubled their money within 18 months. The people who benefited most from that recovery were the ones who kept buying when everyone else was panicking. So move 5 is this. Decide in advance how you will respond if the market drops 20 or 30%. Write it down if you have to. If the S&P 500 drops 20%, I will increase my monthly contribution by X dollars. The investors who get wealthy through recessions are not smarter than everyone else. They just decided their plan before the fear arrived. Here is the honest summary. America lost 92,000 jobs in February, while economists expected gains. Moody's recession model is at 49%, 1 point from a threshold that has preceded every recession in 80 years. And those numbers were calculated before the Iran oil shock. Nobody can tell you with certainty whether a recession is coming. What I can tell you is that the data has never been this pointed without one arriving, and that preparation is not the same as panic. The 5 moves in this video cost you nothing if the recession never comes, and they could protect everything if it does. If this video helped you see the picture more clearly, hit like. It helps other people find this before the number moves. Subscribe for straight talk on investing, personal finance, and wealth building without the noise.